In this video we are going to talk about the dividend snowball effect. So before starting this video, please like this video and subscribe to this channel for our future updates. Consider the following: when you hear the phrase snowball, what is the first thing that springs to mind? When you roll a small and unimpressive white ball, it grows in size and becomes increasingly noticeable. Dividend snowball investment operates on the same principles as traditional investing. A dividend snowball is a cycle of increasing dividend income that continues indefinitely. It is formed by the purchase of shares in dividend growth companies. Over time, the dividend income generated by those shares grows in value. Increased dividend earnings are generated by the addition of new funds, dividend reinvestment, and organic dividend increase, among other things. Initially, the dividend payments that you receive are often insignificant, but you reinvest the money and buy more shares of the company's stock in order to earn a larger dividend payment in the future. As your holdings grow, your little dividend payments will compound into greater dividend payments in the future, as you will own more shares and the company will most likely pay higher dividend rates over time. An investor can choose to freely reinvest dividends, or he or she can enroll in a dividend reinvestment program (DRIP), in which case the company would reinvest the dividend on his or her behalf. You've probably heard of David Ramsey's debt snowball method, in which the borrower pays off the obligation with the least balance first, and then distributes the remaining funds among the remaining bills. The allocation amount is calculated based on the outstanding balance, which expedites the debt repayment procedure for borrowers. The dividend snowball approach is similar to an expansion of this notion, however it is a little more specific in nature. Dividend snowball investing takes advantage of the compounding impact by reinvesting dividends into the acquisition of further stock. By reinvesting, you are increasing the number of shares held, which allows for higher dividend payments in the long run. If you find excellent firms and continue to reinvest over an extended period of time, the results might be spectacular. This means that you should make an ongoing effort to increase your dividends using the dividend snowball method. It is essential that you select high-quality dividend growth stocks, such as those from dividend aristocrats and dividend kings, in order to enjoy the greatest possible benefits from dividend snowball investing. Listed on the New York Stock Exchange, the S&P 500 Dividend Aristocrats is a stock market index comprised of S&P 500 businesses that have grown their dividends for each of the last 25 years. In a similar vein, Dividend Kings has grown its payouts every year for the previous 50 years. According to a study conducted by Hartford Funds, dividend reinvestment and the compounding of returns have been responsible for 78% of the S&P 500's returns since 1978. How does dividend snowball investing work? Once we've established the potential of the dividend snowball method, we can investigate how it actually works. It is possible to compare the growth of your investment over time when you reinvest your dividends with the growth of your investment when you do not reinvest your dividends. The power of compounding serves as the foundation for the dividend snowball effect, which implies that dividends are added back to the original investment amount rather than being used to decide capital appreciation. Consider the following illustration to better comprehend what I'm talking about. Consider the following scenario: you want to put $2,000 into a dividend-paying stock for 3 years. The dividend is compounded annually, which means that it is added to the principal each year, and is used to fund the acquisition of additional stock. Our stock currently trades at $72 per share, with a $4 yearly dividend. The maximum number of shares that you can purchase is $2,000 divided by $72 equals 27.77. Procedures for reinvesting dividends. Select dividend growth stocks that have a track record of increasing their dividends on an annual basis. Make sure, however, that the payout ratio does not exceed 75% of the total. Having a payout rate that is on the lower end indicates that the corporation is more likely to increase dividends in the future. Consistency is essential in the dividend snowball game, so make a monthly contribution to purchase a house if you receive enough dividends. Dividend equities should be purchased at least once a month to ensure dollar cost averaging, which helps to reduce short-term volatility in the broader stock market. This is one of the most effective methods of generating consistent revenue over the long term. Dividends should be reinvested to purchase additional shares, which will accelerate your dividend growth. Furthermore, there are no fees associated with reinvesting dividends, making it a win-win situation for long-term investors. The dividend snowball approach necessitates a constant investment over a period of time ranging from 5 to 20 years in most cases. As a result, patience and perseverance are required in this situation. The advantages of using the dividend snowball strategy. The dividend snowball method is one of the most effective ways to generate a reliable stream of long-term passive income, and this is due to two key reasons. First, it is simple to implement. Using dollar cost averaging, you can accumulate more shares without having to pay a commission on each one. Through their DRIP programs, several corporations sell shares at a discount ranging from 1% to 10% off the current share price. Because of the discounts and the absence of commissions, the cost basis for owning the new shares is significantly lower than the cost basis for holding the shares purchased on the open market. Investors can also purchase fractional shares through dividend reinvestment plans, ensuring that every dividend dollar is put to good use. Compounding returns. The most major advantage of dividend growth investing is the ability to earn higher returns over time. When dividends are increased, shareholders receive a higher sum for each share of stock they possess, which they can use to purchase further shares of stock. Because of this, the overall return potential of an investment increases with time. Due to the lower price of the stock, more shares can be purchased, increasing the chance of long-term gains that are more considerable in nature than previously. How to implement the dividend snowball effect for your retirement account. The majority of investors' priorities a secure retirement with a big corpus of cash and devote their entire lives to asset accumulation. When it comes to increasing retirement income, investing in dividend-paying companies and using the dividend snowball strategy are two of the most effective methods. Over time, the cash that has amassed as a result of those dividend payments can be used to supplement your Social Security and pension income. If investors put in a little effort and forethought, they can generate a significant amount of dividend income. A smart option for folks who want to put money aside for their retirement is to use their dividend payments to buy more stock. They will obtain more large dividends in the future if they continue to use this strategy. Before relying on dividend reinvestment, investors should make a thorough financial plan and ensure that they have other sources of short-term income. Investors can plan to diversify their retirement savings across a variety of vehicles, including additional liquid funds, individual retirement accounts, IRAs, and 401k plans, as well as other investments. This contributes significantly to ensuring that the retiree has sufficient savings and is able to survive without the immediate cash flow from dividends. Dividend reinvestment, often known as the dividend snowball strategy, is a long-term investment strategy. Since the majority of dividend profits are insufficient to cover investors' immediate requirements, they must often continue reinvesting their dividends when they reach retirement age. There will be no significant difference between an individual's annual salary and that of his or her spouse when they are in retirement. However, if an investor continuously reinvests these dividends every year, he or she will be able to increase the size of their portfolio without having to forfeit any extra income. The dividend snowball strategy is one of the most straightforward and cost-effective methods of increasing the value of retirement assets over time. The classic dividend growth equities, such as Procter & Gamble and Coca-Cola, are the best friends of retired investors. These stocks typically increase their dividend rates, which aids in the generation of future returns that outperform inflation. By including such equities in a retirement portfolio, investors are sacrificing a portion of their current dividend return in exchange for a greater payment later on. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.